You're watching Good Business San Diego.
Welcome back. The following segment is brought to you by Wilsey Asset Management. If you are already investing or considering investing in private credit funds, there are some risks that you need to be concerned about. Regulators are now expressing their concerns about private credit. And Chase Wilsey from Wilsey Asset Management is here to tell you why it is that you need to be wary. So walk us through, first of all, Chase, private credit, what is it, who's investing in it, and why is it risky?
Yeah, so private credit, what it is essentially is it's these kind of larger asset managers that are extending loans in many cases to businesses. So it's not like a bank loan, right? You or I go into Chase Bank for fun, right? You know, you go in, you get a mortgage, whatever you want, some type of loan. This is much different because these private managers aren't held to the same scrutiny as the banks. So they're not held to the same regulations as the banks. So that is a big risk that I see within the private credit space. The thing that has happened over the last few years is it really used to be an institutional money space. But now retail investors have started to kind of fall in, and I don't think they're understanding the full risk that they're taking within these investments.
So when we're talking about the risk, of course, number one on any investor's agenda should be minimizing risk. And is it because there's less oversight, looser restrictions on this is where you're exposing yourself to more risk?
Yeah, I think that's the big thing. I talked about the lack of scrutiny, I'll say, but then the other side of the coin is the illiquidity that is there. A lot of times people, if they want to get their money out, you can't. So we saw in the first quarter about $20 billion worth of redemption requests at many of these large private credit institutions. Well, because of the caps that they're allowed to implement, normally around 5, maybe 7% in some cases, there was only about $11 billion that was actually redeemed. So people that wanted out couldn't get out.
So you could be told, no, you can't get your money out?
Exactly.
You're tied up for whatever the period of time is?
And the problem is, it's on a percentage basis. So if every single quarter there's a overwhelming amount of redemption requests, it's done essentially on a percentage basis. So even if, let's say you had a $10,000 investment, and you get out, let's say, $2,000 the first time. Well, now at $8,000. Well, now it's a smaller number. So even if the same amount of redemption requests occur, well, the amount you get out is less because it's a percentage basis. These are, I think, a very troubling asset class, especially for the retail crowd, because they don't fully understand it.
So if there's so much downside, what's the upside? What's the appeal to these products in the first place?
I mean, the big appeal is the interest that you're receiving from it. Sometimes 8, 9, 10%. Yeah, very, very attractive. But anything that really is trading above the 10-year treasury, which is, again, going to be I'm going to say the gold standard for kind of lending, the safest asset that you can take, there's going to be risk to it. And now we're starting to see default risk. We're starting to see that a lot of these private credit firms were borrowing money and leveraging themselves to enhance returns. So there's a lot of potential issues that I see happening in that space.
So you say regulators are now concerned about this, but will there be enforcement to protect the consumer?
That's what's going to be interesting. We've now seen the Treasury Department and the Securities Exchange Commission, also known as the SEC, launch investigations, ask for more information. So we could be getting some, I'm going to say, more insight over the next few months. Maybe it takes a year, I don't know. Sometimes things move slow with the government.
What would the enforcement look like anyway? What would they be able to do?
The concern is maybe more disclosure, more penalties if there were bad actions. But I think a lot of times, unfortunately, they know how to safeguard themselves. So I think this is kind of, if you've done it, there's not much potential for getting your money back if there are bad actions, but hopefully going forward there's more insight, there's more information, so people can make good informed decisions around their investments.
So bottom line, what's the takeaway for investors? What do they need to know? Just stay away from these products entirely, have a consultation with somebody like you, and learn more about them?
I think that's a big thing. If you're being sold these, make sure you understand the potential pitfalls, understand the illiquidity of them. I would not do them. I don't sell them. I don't think they're a good space to be. If you've done them, I wouldn't do more. But as a systemic risk, I don't see it as a big issue. It's about a $1.8 trillion market. Mortgages are $13 trillion. So it's not going to be the same potential thing that we saw in 2007, 2008. I think this isn't going to be a large issue unless you're involved.
Okay, great. Chase, thanks so much.
Thank you.
At Wilsey Asset Management online, smartinvesting2000.com. We'll be right back.